Okay, so everyone loves a good dividend, right?
Yeah,
Like, who doesn't love passive income?
pretty much the dream, right?
Totally. Especially when you're first starting out investing. Those high yields look amazing.
For sure.
But we're diving into some of the dangers there. Like when a stock looks a little too good to be true.
Yeah, exactly. We're going to talk about dividend traps today.
So what exactly, i.e., is a dividend trap?
Well, a dividend trap is not just when a company's dividend decreases.
Okay.
It's when the dividend decreases because of fundamental issues within the company.
Okay.
So it's not just, a temporary dip. It's more of a sign that something is wrong.
Right, so there are these underlying issues that are causing this.
Yeah, yeah.
So it's not just like a normal fluctuation of the market or something like that.
Exactly. So, a company that has a really high dividend yield, they might be trying to lure investors in with unsustainable promises.
So it's a shiny object.
Right. And they're like, hey, look at this really high dividend yield.
Yeah.
But it's like building a house of cards. It looks impressive until the slightest breeze knocks it down.
Yeah, for sure.
Yeah.
So why are dividend traps so tempting?
Well, it's natural to be attracted to high yields.
Yeah.
Especially if you're a newer investor who doesn't want passive income.
Right.
Right.
Yeah.
So, you see a stock that's offering a 10% yield compared to one that's offering a 3% yield. It's easy to be like, oh, I want that 10%.
Right.
But, there's that saying, if it's too good to be true,
Yeah.
it probably is.
It probably is. So what are some red flags to watch out for?
Well, one of the first things you can look at is the dividend yield.
Okay.
So if a dividend yield is really high compared to other companies in the same industry,
Okay.
that could be a sign of a trap. So for example, the average dividend yield in a sector is like 3 to 4%.
Yeah.
And then you see this company offering 10% or more.
Wow.
Yeah, that's when you really need to dig deeper.
Got it. What else? What else should we be looking at?
Well, another thing is you can look at the company's financials.
Yeah.
So
what are we looking for specifically there?
So you can look at things like their debt levels, their payout ratio, and just their overall financial health. So
give me an example of something that would be a red flag in the financials.
So for example, if a company's debt to equity ratio is significantly higher than the industry average, it could be a sign that they're over leveraged and may struggle to meet their dividend obligations.
Got it. So high debt to equity ratio, bad.
Yeah.
What about payout ratio? You mentioned that earlier.
Yeah. So the payout ratio tells you what percentage of a company's earnings are being paid out as dividends. So a really high payout ratio, let's say above 80%, could be a warning sign, especially in cyclical industries.
Oh, interesting.
Because it suggests that they may not be reinvesting enough back into the business.
For the future.
Right.
Yeah, that makes sense.
To grow.
So we need to be like financial detectives here.
Yes.
Looking for clues. Really digging deep.
Exactly. Yeah.
What about recent news and events? How can those play into it?
Yeah, so recent news and events can also provide clues.
Okay.
If a company is facing regulatory challenges or lawsuits, or even just a sudden shift in its market.
Okay.
All of those things could impact their ability to sustain their dividend.
This reminds me of your story about Zim integrated shipping services.
Oh yeah, Zim.
What happened there?
Yeah, I was attracted to their high dividend yield.
Of course.
But I didn't do enough due diligence. I didn't really look into the fact that they were in a very cyclical industry.
Yeah.
And the dividend wasn't as secure as I thought.
Wow.
So I ended up losing money.
Oh, no.
When the dividend was cut and the stock price dropped.
So even seasoned investors can fall for this. So what can we do to avoid making these same mistakes?
Well, one strategy is to focus on companies that have a proven track record of stability and sustainable business models.
Got it.
So these are businesses that have a history of consistent dividend payments and strong financials.
So slow and steady wins the race, kind of.
Yeah, pretty much.
Where can we find these reliable companies?
Well, research is key.
Yeah.
Don't just rely on headlines or really surface level information. You really got to dig into the company's financial reports, understand their industry, and consider their future prospects.
Yeah.
And there are resources like the Dividend Kings list and the Dividend Aristocrats list. These can be helpful starting points because they track companies with a long history of increasing dividends,
Oh, interesting.
which often indicates financial strength
Oh,
and a commitment to shareholder returns.
yeah, that makes sense.
Yeah.
So that's past performance, though. How do we know that they're going to continue to perform well?
That's a great point. You're right to be cautious. Past performance isn't a guarantee of future results,
Right.
but it does give you a good starting point for further research.
Okay.
So again, the key is to look for companies that have solid fundamentals
Okay.
and a sustainable business model. Don't just chase a high yield.
So realistic yield expectations are important.
Definitely.
Should we, like, maybe aim for that 3 to 4% range?
Yeah, 3 to 4%.
Instead of getting,
Yeah.
starry-eyed over
Yeah.
these really flashy
Exactly.
high yields.
Yeah, chasing yield can be so tempting,
Totally.
but it can lead you right into a trap.
For sure. I think the main thing here is sustainable income.
Absolutely, that's the
This has been so insightful. I feel like I'm finally starting to see these dividend traps for what they are.
Good.
So to wrap up, I think the main takeaway is informed decisions are our best defense, right?
Yes.
We need to do our research,
Mhm.
dig deeper, and prioritize sustainability over those tempting high yields.
Couldn't have said it better myself.
So I guess my last question for you is, what else should we be thinking about?
Well, I think something to think about is what are some industry-specific factors that could potentially mask a dividend trap?
That's a great question.
Yeah,
There's always more to learn. Thanks so much for taking the time to break this down for us.
of course.
Really appreciate it. This has been a real eye-opener.
Glad to hear it.
Thanks for joining us on the deep dive.
Thanks for having me.